If you're new here, welcome. My name's Paula, and on this channel I break down what's actually moving the crypto markets. Without hype, without fear-mongering, and without pretending every headline means price is about to explode or collapse overnight. What I try and do here is step back a little, connect the dots between macro, liquidity, structure and sentiment, and help you understand why the market behaves the way it does, especially during periods like this, where nothing feels very clear. And this is definitely one of those periods. Because over the last few weeks, we've talked a lot about Japan. We've talked about the Bank of Japan potentially raising rates. We've talked about the yen, carry trades, global liquidity, and how all of this could affect crypto. And depending on who you listen to, this rate decision was either going to completely crash Bitcoin, or it was going to be the most bullish thing that ever happened. Well, the decision has now happened. So today, instead of speculating or reacting emotionally to headlines, I want to slow things down and look at what actually happened, what impact we've really seen in the market so far, and what genuinely matters next. Because when something is talked about this much in advance, the real story usually starts after the event, not before it. The Bank of Japan raised interest rates to around 0.75%, which doesn't sound dramatic at first. But for Japan, it's a very big deal. This is the highest policy rate they've had in roughly 30 years, and it marks a clear shift away from decades of ultra-loose monetary policy. Cheap money, zero rates, and consistent support have been the norm for a long time. So structurally and symbolically, this matters. But here's the key thing that often gets missed when people react to events like this. The market already knew this was coming. This wasn't a surprise decision, it wasn't unexpected, and it wasn't something that traders had to suddenly reprice overnight. For weeks leading up to this, probability models were already pricing in a rate hike, and institutions had time to position, hedge, or reduce risk. And when markets are prepared, reactions tend to be muted. That's exactly what we saw. Bitcoin didn't collapse, but it also didn't explode higher. We saw a bounce, yes, but price largely stayed within the same broader range it's been trading in for a while now. The yen moved, but not violently. Japanese bond yields rose, but in a very orderly way. Equity markets stayed relatively stable. And that tells us something really important. This wasn't a panic moment. It was a confirmation moment. The market didn't need to aggressively reprice risk because most of that work had already been done ahead of time. And this is one of the hardest things for newer traders to internalize. But it's crucial. Markets don't move on news. They move on surprises. And this time, there wasn't one. Now, a lot of people immediately ask, but aren't rate hikes bad for crypto? And the honest answer is, it depends. In theory, higher interest rates are headwind for risk assets. They tighten liquidity, increase borrowing costs, and make speculative assets less attractive on paper. And historically, when Japan tightens policy, it can create pressure across global markets, especially through the unwinding of yen carry trades. That part isn't wrong, but markets don't operate in theory. They operate in expectations, timing, and positioning. This wasn't Japan slamming the brakes overnight. This was Japan taking a small expected step while still signalling caution. Real rates in Japan are still negative, financial conditions remain accommodative by global standards, and the forward guidance from the Bank of Japan was measured, not aggressive. So instead of a sudden liquidity shock, what we're seeing is something slower and more controlled, a transition. One of the most interesting things about this entire move is actually what didn't happen. Bitcoin didn't lose key structural support. There was no liquidation cascade tied directly to the decision. We didn't see forced selling spiral out of control. And that tells us the market wasn't dangerously over-leveraged going into this event. A lot of weak positioning had already been flushed out earlier. Risk had already been reduced, and traders were far more cautious than many people realised. That's why the reaction felt boring. And boring doesn't mean bullish. But it also doesn't mean bearish. It means balanced. If the rate hike itself wasn't the main event, then what really matters now is forward guidance. What the Bank of Japan does next and how they talk about it matters far more than what they just did. Yes, further hikes are probable if inflation and wages remain strong, but Japan also has massive debt, and higher rates dramatically increase interest costs. That reality puts a natural limit on how far and how fast tightening can go, which is why markets are paying much closer attention to tone and language than to the headline rate itself. At the same time, crypto is being pulled in two directions. On one side, global liquidity is tighter than it was a year ago. Rates are higher across most major economies, and easy money is no longer the default setting. That naturally caps explosive upside in the short term. But on the other side, there's market structure. One of the biggest reasons price has felt stuck recently has very little to do with Japan directly and a lot to do with derivatives. There's a large amount of Bitcoin options open interest clustered around the current price range, particularly near the $88,000 area. When that happens, market makers hedge aggressively. Gamma exposure increases, and price often gets mechanically pinned near those levels. That suppresses volatility and creates the illusion that the market is weak or indecisive, when in reality it's being structurally constrained. That's why big moves often happen after major option expiries, not before them. So now that the Bank of Japan decision is behind us, attention shifts forward. Post-expiry price behaviour will matter a lot. Once those contracts roll off, the artificial pressure holding price in place often disappears. And that's when markets start to show real intent. Liquidity conditions heading into the new year also matter. Thin liquidity can aggravate moves in both directions, which is why this isn't the environment to overtrade or chase noise. Macro data out of the US still plays a huge role as well. Inflation, labour market data, and central bank commentary continue to influence dollar strength and risk appetite. And finally, Japan's next signal matters. Not the next hike, but the next shift in tone. Before I wrap this up, I want to quickly mention Blowfin, because a lot of you ask where I actually trade and why. Blowfin is the exchange I use because it's built for traders who actually care about structure, execution, and risk management, not just hype and high leverage. They've got deep liquidity, clean charting, and solid risk controls, which really matters in environments like this, where price is range-bound and volatility can expand quickly. They also support the channel, which means there are bonuses on deposits, trading rewards, and community incentives available to you if you choose to use them. All linked below. But as always, the platform is secondary to the plan. No exchange fixes bad risk management. So zooming out, here's the honest reality. This wasn't a crash signal, but it wasn't a green light either. What we're in right now is a transition phase, one that rewards patience, discipline, and preparation far more than conviction or prediction. Markets don't move when everyone agrees. They move when positioning breaks. And until that happens, understanding why nothing happened is often more valuable than chasing what might happen next. If you found this breakdown useful, make sure you hit like, make sure you're subscribed, because I'll keep updating as structure develops, not just reacting to headlines. Thank you so much for watching, and I'll see you in the next one.